Atocha Global Analytics. Please like and subscribe.
Greetings, salutations, and howdy to you all. Welcome back to the channel. I'm KT with Atocha Global Analytics. As always, I wish to remind you that Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. So today I wanted to highlight the soaring costs of home ownership in Florida and thus also demonstrate how unsustainably high the cost of home ownership is in this state. So if you haven't seen my recent series entitled How Do You Figure Out What a Home Should Be Worth, the links are in the description. But this video references one thing specified in the latter part of that series, which is that the pricing of the housing market, because of our reliance on mortgage financing, more than 65% of all borrowers state and nationwide, that reliance is inexorably tied to median household incomes. So putting it in context here, ignoring all the recent inflation, the median household income in this locale, this zip code, has not yet really reclaimed its 2019 levels, technically. And, despite the gains that were made in the late 2010s, by the way. But incomes had not really kept up with things in recent years anyway here. So we want to, kind of compare costs now against where we were in 2021 before the inflation rate took off and housing prices became so overpriced. So just an FYI, housing costs within this analysis are going to be for owners. It's not for renters. And it will just include the financing costs, property taxes, and insurance costs. So costs of maintenance and other factors, they are definitely increasing, but they vary based, really on the subjective property you happen to be looking at. And, so they aren't tracked data like these three primary components of housing costs are. And so that's why we're covering those items. And, so here we're going to look at two side-by-side comparisons for the exact same house. However, looking at it first as somebody who bought in 2019 will, be then contrasted with somebody buying today. And as well, we're going to track out how the insurance costs have changed in the interim because that has actually just really hit the housing market within the last few weeks. So here happens to be the cost of a 2,300 square foot or so, 3-bedroom, 2-bath, 2-car garage with an office. It's around 40 years old, or was in 2019. Of course, it had been updated somewhat, so it was effectively about 28 years old at that time. Being purchased in July of 2019, the house cost was $225,000. With an 80% loan-to-value mortgage, that equates to a $180,000 mortgage. So, in doing the analysis, let's add a realistic wrinkle here. Anybody buying in 2019 saw that the values started to go up significantly and that rates went down. So they did what everybody else did. They refied. They pull out the a little cash, do some updating, pay off some bills, but they're still wanting to stay, a little conservative with the loan to value and not run up the, exorbitant balance. So they end up with a $210,000 mortgage. They do that in mid 2021, and it obviously serves the budget really well, and they've been able to take care of some things. So, with that $210,000 mortgage in mid 2021. The payment is pretty reasonable as compared to what a buyer today would have to do. But we have a house value of $445,000 today in July of 2023. That means if you were to make an 80% loan to value purchase today, just like they did in 2019, it will now cost you $2,121.17 in mortgage payments instead of the $591 per month they were paying then. And that payment for the same house today would be a huge 259% higher. Once they did the refi, that payment, of course, in 2021, that payment dropped from $591 to $518 and 1 penny. So anyway, big numbers there. But let's move on and talk about insurance. But before I cover the epic increases in those costs, please take a moment and like, subscribe, ring the notification bell if you would. I thank you very much. So yeah, insurance costs have skyrocketed in Florida. And I'll just say for reference, having lived through the last real estate cycle in Florida, I can tell you that the catalyst that stalled much of the South Florida housing market in 2005 were the insurance costs skyrocketing after the four major impacts of the hurricanes in 2004. So again, the real estate market was impacted, but it was tempered in mid 2005. This is before Katrina or the 2005 hurricane season even began. So the market responded when those premiums in some areas, they literally doubled and tripled as a result of the 2004 impact. So the market responded by basically plateauing at that point, which is what we've seen for the last 12 plus months. And back in 2005, the market in South Florida pretty much just languished until the rest of the country became infected by the subprime issues, and the national real estate cycle turned down starting around 2017. Or 2007, I'm sorry. And just to note the obvious, we have those similar stresses present in this market right now, but it's actually been more profoundly impacted in recent years than 2005 because insurance has gone up more and for longer. Values went up even faster, and the rates went up much more significantly than they had in the last cycle. In the last cycle, the Fed only raised it 4% from 1% to 5% through 2005, where it's gone up at this point 5+% rather than the 4% difference that we had seen then. So here's what we've seen for increases. Since the house was bought in 2019, insurance premiums are up more than 3 times. And I just found that from a recent news story that was shared with me that got the data from the state. So, that's an epic and it is an unsustainable increase. Yet, the market keeps chugging along and everybody keeps telling you that everything is fine. But let's see how this affects the costs in real numbers. So the insurance in this particular example went from $1,326 per year in 2019 to $5,408 per year this year. That's a 308% increase in those 4 years. That also means that the insurance cost is about $451 of the monthly budget. That right now is approaching the cost of the mortgage payment for this home. And that's just incredible. And, that's actually not the most shocking thing right now. We're going to cover that right now. See, we still need to cover taxes. Now, Florida's homestead exemption and the Save Our Homes program limits the property taxes for those that claim the exemption every year. And it's, so beneficial to somebody who has owned for a while. But here's the shocking stat. Somebody who has owned and has homesteaded their home since 2013 or before is paying only about 30% of the tax bill of somebody who buys literally a similar valued home right next door today. And why is that? Well, it's because the market has increased so fast and the existing owners with homestead exemptions benefit from caps on their tax increases. And as such, the new buyers carry a lot more of the burden. So it's good for some and bad for others. And so I have a few questions I'd like to ask and answer. But before I cover, the next horrific aspect of the current Florida reality, please like and subscribe, and I appreciate that. So here's some questions I naturally asked when I saw all this data. And so I thought about, how about affordability? What is it right now? What do interest rates need to be to make things affordable again? What do values need to be for things to be aligned with that median household income? So here's some of those answers. So with the specific example I've already given you, the difference between the mortgage payments is staggering even before we dissect these other numbers. So, and, once you do the analysis, it becomes even more astounding. So, but the combined principal, interest, taxes, and insurance, or PITI, the combined PITI payment for purchasing this one specific house example with an 80% loan-to-value mortgage and financed at market values 24 months apart increases the total for the mortgage by $2,071.91. The aggregate increase to buy and own that house increased 262% in 24 months. That's just astonishing. So here's a summary of some of the increases to the example home in the market in general, just so you can kind of see how this plays out. Median housing prices in 48 months are up 47%. Insurance costs for an average house, even when having no claims or any extraordinary risks changing anything about the house, in 48 months, it's up 300%. Total increase in financing costs due to interest rates alone, ignoring any change in value in the last 18 months, that's 61%. And lastly, the increased cost for the financing component, due to value increases and the increased interest rates, that's 309%. So I guarantee you that median household incomes have not increased enough to support these increases without undermining the market. As noted a moment ago, the aggregate cost for just the principal and interest, those increases for the example house in 24 months, that's 262%. So now for some real analysis. When you create a multiplier showing the median income to median value, you see it increases from 3.65 to 5.42 over that time frame. And by historical standards, it actually started out a tad low in that 2019 time frame, but it is now well above the historic norm of 4.4 to 4.6. However, when you annualize the PITI and divide it by the income to create a ratio, it seems even easier to really see how the changes have occurred. And also, by the way, doing it that way, it's similar to the qualification metrics used for obtaining a mortgage. So, most lenders want borrowers to be around 28% of their income attributed to housing costs. Well, this area, the zip code, started out at about 25.7% in 2019 and has ended up at nearly 52% today. That is way outside the norm, and it eliminates a huge swath of potential buyers. Of course, if you go back and look at news stories or videos about why the housing market is held up, the answer is really simple, really. Nobody who currently owns can move and remain in a comparable house or trade up without crushing their budget. So they're just staying put. Basically, homeowners are hoarding their affordable rates and are effectively stuck waiting for something to change. So unless the cost of taxes and insurance, that's the T&I and the PITI amount, unless those taxes and insurance costs plummet in the near future, values and or interest rates really must change to rebalance the market. So how much is that? Well, here's 4 mini tables with some quick calculations for you to kind of demonstrate that. And before I lay these 4 out, please take a moment to like, subscribe, and click that notification bell for us, and I appreciate that. So the median household income for 2022 is just under $72,000 for the zip code, and we'll use $72,000 for this year's. We're not going to get the 2023 stats until 2024. So, but the median housing price in the zip code is $390,000. Again, the historical average relationship between these two is about 4.4 to 4.6. This means the median house price should be about $317,000 to $331,000. Obviously that's a bit lower than the current values. However, the insurance and taxes in Florida are well above historic norms too. So the P&I and PITI really gets hit by the T&I in that PITI. So let's look at that aspect of it for a moment. Using the median household income and a housing cost factor, which is basically what the typical buyer could qualify for, I've created 2 parallel totals. One is at the historic 28%, and the other is at an elevated 34%. And the thinking behind that is, I want to highlight that the typical buyer is not the same as the typical homeowner in any given area. The typical buyers are often earning more than the typical homeowner. Or a bit above the median household income, because you have retirees on fixed incomes that have been in their home for years included in the ownership pool. And that's just one example of maybe some lower incomes included in median household income, because you also have renters. Renters are included in median household income as well. So, but they aren't necessarily in a position to buy when their income may be low. So anyway, I used 34% to project a more common income associated with buyers. So the median insurance and median tax costs work out to be about 1.02% and about 2.08% respectively. and leaving a proportionally lower amount available for principal and interest, because that 3+% is higher than the national norms. By the way, since taxes and insurance both change based on values, the comparisons I've created here, they have to be quite dynamic to reflect the shift in contributory values. But anyway, I wanted to calculate things at today's interest rates and also at what we had in 2021 before the Federal Reserve began raising rates. So at today's rates, the housing price is end up ranging from $180,000 to $218,600. That's around half of today's $390,000 median housing price. So that's pretty scary. But how about if the interest rates come down? Well, here you go. It's better, but prices still end up having to decline. We're at $248,000 based on a 28% housing cost factor, and $301,200 based on that 34% housing cost factor. One more quick set of calculations. What kind of housing cost factor does it take to support $390,000 median housing price like we have here? Well, here it is. We're at a 60.7% housing cost factor with a 7.15% interest rate, like what I've recently sourced in preparing this. And even at the old 2.96%, we end up with a 44.03% housing cost factor, and that's as if the interest rates dropped down to the 2.96% we saw in early 2021. So that last example really shows you that lowering interest rates back down won't resolve the Florida problem. If the property tax rates and property insurance premiums don't decline by somewhere in the neighborhood of 50%, which would be totally unprecedented, obviously, but even lowering interest rates, even the lowest level on record, will do little more than just lessen the fall here. Prices have to come down in order to regain balance in supply and demand with that fundamental pillar that supports the housing market, which is median household income. So it may take some time for enough sellers to be motivated enough to put homes on the market, but it will happen. Economic fundamentals will eventually win. So another substantial video. If you would, please take a moment to like, subscribe, and click that notification bell. Thanks for sharing the journey with me, and I'll see you in the next video.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.